I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. How to Invest in Bonds by Usiere is a comprehensive guidebook for investors looking to understand and navigate the world of bonds. The book provides a clear and concise overview of bonds, how they work, and the different types available to investors. The author takes a pragmatic approach to explaining the subject matter, making it accessible to investors with varying levels of knowledge and experience. The book begins by introducing readers to the basics of bonds, such as how they differ from stocks, how they generate income, and how they are priced. Usiere then delves into the different types of bonds available, including government bonds, corporate bonds, municipal bonds, and international bonds. He explains the pros and cons of each type of bond, as well as the risks associated with each one. One of the strengths of the book is the author's ability to explain complex concepts in simple terms. He breaks down difficult financial jargon and provides examples to help readers understand the concepts. The author also offers practical tips on how to choose the right bonds for your investment portfolio, as well as how to evaluate the performance of your investments over time. Another highlight of How to Invest in Bonds is the author's discussion of bond funds and ETFs, exchange-traded funds. Usiere provides readers with a comprehensive understanding of these investment vehicles and how they can be used to build a diversified portfolio of bonds. Overall, How to Invest in Bonds is an excellent resource for anyone looking to invest in bonds. The book provides a comprehensive overview of the subject matter, while also offering practical tips and advice on how to build a successful bond investment portfolio. Whether you are a seasoned investor or just starting out, this book is definitely worth reading. When you invest in a bond, you are essentially loaning money to an entity, such as a corporation or government. In exchange for your loan, the entity pays you a fixed interest rate over a set period of time. This interest payment is typically made semi-annually or annually, depending on the terms of the bond. Unlike stocks, which represent an ownership stake in a company, bonds do not give you any ownership rights. Instead, you are simply acting as a lender to the bond issuer. When the bond reaches maturity, the issuer repays the principal amount of the bond to the investor. Because bonds are generally considered less risky than stocks, they are often seen as a safer investment option. However, different types of bonds carry different levels of risk, depending on factors such as the creditworthiness of the issuer and the length of the bond's maturity. Overall, investing in bonds can be a good way to generate income and diversify your investment portfolio. By understanding how bonds work and the different types available, you can make informed decisions about which bonds to invest in and how to manage your overall investment strategy. There are several types of bonds available to investors, each with its own set of risks and rewards. Government bonds are issued by national governments and are considered one of the safest types of bonds because they are backed by the government's ability to tax its citizens. These bonds typically have lower interest rates than other types of bonds, but they are seen as a reliable source of income for investors. Corporate bonds are issued by companies as a way to raise capital. The interest rate on corporate bonds is typically higher than government bonds, but they also carry a higher level of risk. The creditworthiness of the company issuing the bond can impact the bond's value, and if the company goes bankrupt, bondholders may lose their investment. Municipal bonds are issued by local governments and are often used to fund public projects such as schools and roads. These bonds are generally exempt from federal taxes and may also be exempt from state and local taxes, making them an attractive investment option for some investors. International bonds are issued by foreign governments or companies and can provide investors with exposure to global markets. These bonds carry a higher level of risk than domestic bonds due to currency fluctuations and political instability in other countries. Understanding the different types of bonds available can help investors build a diversified portfolio that balances risk and reward. By spreading investments across multiple types of bonds, investors can reduce their overall risk while still generating income from their investments. The creditworthiness of the bond issuer is a critical factor to consider when investing in bonds. This is because the issuer's ability to repay the bond's principal and interest is what ultimately determines the value of the bond. To evaluate the creditworthiness of a bond issuer, investors can look at the bond's credit rating. Credit rating agencies, such as Standard & Poor's and Moody's, assign ratings to bonds based on the issuer's ability to repay their debts. Bonds with higher credit ratings are considered less risky and typically offer lower interest rates, while bonds with lower credit ratings carry a higher risk, but may offer higher returns. Investors can also look at the issuer's financial statements and credit history to assess their ability to repay the bond. Factors such as the issuer's revenue, profitability, and debt levels can all impact their creditworthiness and the value of the bond. It is also important to consider the maturity of the bond when evaluating credit risk. Short-term bonds typically carry less risk than long-term bonds because they have a shorter period of time for the issuer to default on the bond. Investors should carefully evaluate the creditworthiness of the bond issuer before investing in their bonds. By doing so, they can make informed decisions about the level of risk they are comfortable taking on and ensure that their investments align with their overall investment goals and strategy. Bond funds and ETFs, exchange-traded funds, can provide investors with a convenient way to invest in a diversified portfolio of bonds. Bond funds are mutual funds that invest in a portfolio of bonds. By pooling the money of multiple investors, bond funds can provide access to a wide variety of bonds with varying levels of risk and reward. Bond funds can also offer professional management, which can be helpful for investors who lack the time or expertise to manage their own bond portfolio. ETFs are similar to mutual funds, but they trade on an exchange like a stock. Like bond funds, bond ETFs invest in a portfolio of bonds and provide investors with access to a diversified range of bonds. One advantage of bond funds and ETFs is that they offer investors the ability to invest in a diversified portfolio of bonds with a relatively small investment. This can be especially beneficial for investors who may not have the resources to build a diversified bond portfolio on their own. However, it is important to carefully evaluate the fees and expenses associated with bond funds and ETFs. These costs can include management fees, trading fees, and other expenses, which can impact the overall return on investment. Investors should also be aware of the risks associated with bond funds and ETFs. Like any investment, bond funds and ETFs can fluctuate in value and are subject to market risk. Additionally, some bond funds and ETFs may invest in riskier bonds, such as high-yield or junk bonds, which can carry a higher level of risk than investment-grade bonds. Overall, bond funds and ETFs can be a useful tool for investors looking to build a diversified bond portfolio. By carefully evaluating the fees and expenses associated with these investment vehicles and understanding the risks involved, investors can make informed decisions about how to incorporate bond funds and ETFs into their overall investment strategy. Investors should regularly evaluate the performance of their bond investments and adjust their portfolio as needed to maintain a balanced and diversified investment strategy. One way to evaluate the performance of a bond investment is to look at its yield, which is the interest rate paid by the bond issuer divided by the bond's price. Investors can also compare the yield of a bond to other bonds with similar credit ratings and maturities to assess whether the bond is providing a competitive rate of return. Another factor to consider is the overall performance of the bond market. Like any investment, the value of bonds can fluctuate based on market conditions. By monitoring the overall performance of the bond market, investors can gain insight into how their individual bond investments are likely to perform. Investors should also regularly review their bond portfolio to ensure that it remains balanced and diversified. This can involve adjusting the allocation of investments across different types of bonds or rebalancing the portfolio based on changes in market conditions or the investor's investment goals. In addition, investors should regularly assess their overall investment strategy to ensure that it aligns with their long-term financial goals. This may involve reassessing risk tolerance, adjusting investment allocations, or revising investment goals. Overall, regular evaluation and adjustment of bond investments can help investors maintain a balanced and diversified investment strategy, minimize risk, and maximize returns over the long term. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.